Welcome to the Deep Dive, the show where we cut through the noise, sift through the data, and, well, try to find the real story behind the numbers.
Yeah.
Have you ever looked at a financial report, pages and pages of figures, and just wondered where to even begin? How do you find the truly important nuggets that tell you what's really going on?
Oh, absolutely. It's like searching for treasure, isn't it? In this huge ocean of information. Without a good map, the right tools, it can feel, well, overwhelmingly complex, even if you've been investing for a while.
That's precisely the challenge. And our mission today is to give you that map to help navigate Sunway REIT's latest quarterly results. We're embarking on a pretty comprehensive analysis, specifically digging into their Q2 2025 and Q1 2025 reports.
And comparing them crucially to prior periods. That's how you spot the trends, the insights.
Exactly. Moving beyond just the headlines to equip you, our curious listener, with let's say, a well-informed understanding of Sunway REIT's financial health, their operational side too.
And to do that, we've pulled together quite a stack of sources. Obviously, Sunway REIT's official Q1 and Q2 2025 financial reports. Those are key. But we've also got external expert analysis, like the recent RAM ratings affirmation that just came out in August.
A lot of useful context.
Very. And insights from our own past discussions, too, like our deep dive into their Q4 2024 review. It helps weave together a richer picture, getting multiple perspectives.
That richer picture is crucial. And speaking of our previous deep dive, remember that massive aha moment? It really frames today's discussion perfectly. In Q4 2024, Sunway REIT hit this huge milestone. They crossed the RM10 billion mark in assets under management, AUM.
Yeah, that was big news. Only the second REIT in Malaysia to do that.
Right. But why is that such a game changer for them specifically? Beyond just being a big number, what does it signal about their stability, their competitive edge?
Well, it's an incredible feat, and it's definitely more than just bragging rights. Crossing that RM10 billion AUM threshold, it fundamentally changes their position in the market. It means they have the scale, the financial muscle to go after larger, more impactful acquisitions, deals that smaller REITs, frankly, couldn't even touch.
So bigger opportunities open up.
Exactly. And that enhanced scale, it often translates into better borrowing terms, more efficient management across their, diverse portfolio. And importantly, it boosts investor confidence. It signals they're a mature, dominant player capable of sustained growth.
And it wasn't just luck, right? It was driven by that strategic diversification we talked about.
Absolutely. Sunway REIT isn't just about, say, massive shopping malls. They've intentionally spread their bets across retail, hotels, offices, industrial properties, even services.
It's like they're not putting all their eggs in one basket, which, as we discussed then, helps them stay incredibly resilient, even when, specific economic conditions wobble.
Precisely. If one sector takes a hit, maybe offices struggle with remote work trends. Another, like retail or industrial, can often pick up the slack.
It provides that buffer, that safety net for investors against market shocks. You can see that strategic foresight really paying off, especially now. Okay, let's unpack this then. The latest numbers are in, and there's a lot to dig into from their Q2 2025 report, fresh off the press, and the Q1 2025 figures that came before it. It's not just about what they reported this quarter in isolation, but what it means in the context of their past performance, looking for those critical trends.
Yeah, and what's fascinating here is how these latest numbers, they don't just tell their own story, but how they track against previous quarters. That's how we reveal those underlying trends, assess, management efficiency, understand the strategic direction they're taking, seeing the forest, not just the trees.
Right. And the overall picture, when we look at the latest cumulative figures, that's Q2 2025 year-to-date compared to Q2 2024 year-to-date, it looks, pretty impressive. Their revenue saw a notable increase, 21.5%, rising from roughly RM 354 million in the first half of 2024 to RM 430 million in the first half of 2025. That's strong top-line growth. What's driving such a big jump?
It is strong. A 21.5% increase year-to-date is a powerful signal. It mainly reflects their expanding asset base and improved operational performance. The surge is primarily thanks to the full quarter's income contribution from those 9 new properties they bought throughout 2024.
The hypermarkets and malls.
Exactly, particularly the 6 hypermarkets in Sunway 163 Mall. Those assets hit the ground running, contributing straight to the top line, alongside generally better performance across their existing retail portfolio as well.
And that strength carried through to the net property income, or NPI. That's the profit from the properties themselves after running costs. It jumped a robust 20.1%, went from about RM 260 million to RM 312 million in that same year-to-date comparison.
Yeah, and the fact that NPI growth is tracking so closely with revenue growth, that's a really positive sign. It suggests continued, healthy property management efficiency. They seem to be controlling costs well as income grows.
Which must be a challenge, right? Given the inflationary pressures we've seen on operating expenses in Malaysia, utilities, labor costs, maintaining that MPI margin can't be easy. How are they managing that? Did the report give any clues about specific cost control or efficiencies?
That's a crucial point. Achieving that NPI growth alongside revenue, especially with rising costs, it does speak volumes about their active asset management. Now, the high-level reports don't always break down specific cost controls line by line, but we can infer a few things. Firstly, the sheer scale they now have from those recent acquisitions likely gives them better economies of scale. Think property management fees, maintenance contracts, maybe even bulk buying for utilities.
Makes sense.
Secondly, their focus on those asset enhancement initiatives, AEIs, often involves smart building tech. That can directly lead to energy savings, lower utility bills.
Okay, so tech helping the bottom line.
Potentially, yes. And finally, strong tenant retention and maybe favorable lease structures can help offset rising costs by securing consistent, maybe even escalating rental income. It seems like an integrated approach.
Okay. Now, when we look at the profit for the period, the overall profit, there was a slight increase, just 0.7%, up from RM 232 million to about RM 234 million year-to-date Q2 versus Q2. But this figure includes both realized and unrealized bits, right? Which is an important distinction we need to remember.
Absolutely crucial, because for investors, the most critical metric is often that realized income attributable to unit holders. That's the actual cash generated from operations, the stuff available for distribution. And here, Sunway REIT delivered a strong 21.9% increase. It went from RM 160 million in YTD Q2 2024 to RM 195 million in YTD Q2 2025.
Okay, that's a much clearer picture of operational strength.
It really highlights their core performance and their ability to generate that consistent distributable income.
And that leads directly to the distribution per unit, the DPU, the bit most REIT investors focus on. They've proposed an interim DPU of 5.68 sen for the first half of 2025. That's a significant jump, 21.9% up from 4.66 sen for the same period last year.
A record high, in fact.
A record high that definitely underscores their commitment to sharing profits with unit holders. For our listeners, seeing a DPU not just growing but hitting a new record must be, well, a very positive signal.
It absolutely is.
How does that translate into yield compared to other Malaysian REITs? Is it competitive? And how sustainable does that growth look?
Yeah, good questions. A record DPU is definitely attractive, especially when investors are hunting for stable income. While the report doesn't give us exact real-time yield comparisons, a 21.9% DPU increase certainly positions them competitively. As for sustainability, well, that comes back to their diversified portfolio, doesn't it? The strong retail performance, combined with those strategic industrial acquisitions, provides multiple income streams that can support the DPU growth.
But there are always factors to watch.
Always. You've got interest rate movements affecting finance costs, and of course, the ongoing operational performance of each segment, which we need to dive into. Those will shape future DPU growth.
Okay, let's shift from the year-on-year cumulative view to a more granular quarterly comparison, looking at Q2 2025 versus Q1 2025. Here we see a few slight dips. Rental and lease income, for instance, saw a small decrease, 3.7%, down from RM 213 million in Q1 to RM 205 million in Q2.
And that translated into a 3.4% dip in overall revenue, quarter on quarter. From about RM 219 million down to RM 211 million. The net property income also saw a modest 1.5% decrease, Q2 versus Q1, down from RM 157 million to roughly RM 196.5 million.
Similarly, the realized income attributable to unit holders, that key metric, saw a slight 2.1% decrease quarter on quarter, from about RM 98.6 million down to RM 96.5 million. Okay, so small dips across the board quarter on quarter. But here's the slightly confusing part. Despite those dips in revenue and NPI, the overall profit for the period actually increased significantly. By 24.0% QQ, it jumped from RM 104 million to RM 129 million. How does that work?
Right, it seems counterintuitive, doesn't it? But this jump in the overall profit is largely down to a significant unrealized gain of RM 27 million. This came from the proposed disposal of the Sunway University and College campus. It's basically a revaluation gain booked in anticipation of the sale.
So it's an accounting thing, not operating income.
Exactly. It factors into the total profit for the period on paper, reflects a potential future value uplift, but it doesn't directly translate into cash available for distribution right now. It's a paper gain.
Got it. So if you're an investor, Keep your eye on the realized income for the true picture of operational performance. Don't get too swayed by that overall profit figure, which can jump around because of these one-off unrealized gains.
Precisely. Slight quarter-on-quarter fluctuations are normal. You have to see them in context. Long-term trends, specific events like disposals.
But does relying on these potential disposal gains to boost total profit risk masking any underlying slowdowns in core income? How do we know if it's strategic asset recycling versus, propping up the numbers?
That's a very sharp question, and it's where the nuance lies. For Sunway REIT, given their stated Transcend 2027 strategy, which is all about portfolio optimization and asset recycling, these disposals do seem part of a deliberate plan. They're looking to divest mature or maybe non-core assets to free up capital. Capital they can then reinvest into higher growth or more strategic property, like those industrial ones we'll get to.
So it's more about optimizing capital allocation.
That's how it appears, yes. Less about masking inefficiency. But you're right to flag it. Investors absolutely need to look beyond the headline profit for the period and scrutinize the realized income. Consistent realized income growth, like we saw year to date, that's the true indicator of operational strength.
Exactly. Okay, let's add more context. Let's look at Q1 2025 against earlier periods. Compared to Q1 2024, Q1 2025 showed really strong year-on-year growth, didn't it? Revenue up 22.6%, MPI surged 20.4%, and that crucial realized profit attributable to unit holders increased 20.2% year-on-year. That's a powerful picture for Q1 2025. What drove that?
Yeah, that strong YoY growth for Q1 25 was primarily driven by having a full quarter's income from those properties acquired in 2024. The 6 hypermarkets, Sunway 163 Mall, Sunway Klong Mall, they provided a substantial, immediate boost to both the top and bottom lines, a big portfolio expansion.
But wasn't there an offset?
There was, partially. It was partially offset by reduced cash balances. Obviously, they spent capital on those acquisitions and higher finance costs during the period. That reflects the general rise in interest rates and the increased borrowing needed to fund the expansion.
And what about Q1 2025 compared to the quarter immediately before it, Q4 2024? I seem to remember Q4 having some unusually large valuation gains, making its total profit look massive.
You remember correctly. Comparing Q1 25 to Q4 24, the realized profit actually showed a healthy positive increase of 4.1%, a good sign of continued operational momentum. However, the MPI dipped by 5.1% quarter-on-quarter, even though rental and lease income still managed a 3.7% rise.
So rents were up, but MPI was down. How does that happen?
Higher costs. It tells us that while rental collections were improving, property operating expenses were notably higher in Q1 25 compared to Q4 24, up 11.5% actually.
11.5%.
Yeah, and finance costs, while they were down 6.5% quarter-on-quarter, were still a significant factor hitting that MPI margin. That jump in operating expenses is definitely something to watch, reflecting those broader inflationary pressures, utilities, maintenance, admin costs.
And Q4 2024 itself was skewed by those big valuation adjustments, right?
Massively skewed. Q4 24 benefited from significant unrealized fair value changes in investment properties over RM 107 million.
Just paper gains again.
Exactly.
Right. Okay, here's where it gets really interesting, I think. What specific parts of their diverse portfolio are driving these shifts? And what operational stuff is shaping future cash flows? This is where we see that diversification strategy in action.
Indeed. Connect this to the bigger picture, and you see how their strategic diversification and that active asset management are playing out in a pretty dynamic market. Each segment tells its own story within the bigger Sunway REIT narrative.
Let's start with what looks like the growth engine, the retail segment. Q1 2025 performance was impressive. Revenue at RM 168.4 million, up a huge 33% year-on-year.
Massive jump.
And NPI wasn't far behind, RM 116.8 million, up 34% year-on-year. This was clearly a key driver of their overall positive performance.
Absolutely. The main contributors. Those new rental streams from the 6 Sunway REIT hypermarkets, Sunway 163 Mall and Sunway Klong Mall, all acquired in 2024. These strategic additions immediately started bolstering the retail segment. It really shows the value of that acquisition strategy paying off quickly.
And it's not just about buying new stuff. Their asset enhancement initiatives, AEIs, are clearly working too. Sunway Pyramid Mall's Oasis Wing revamp reopened November 1st, 2024, significantly boosted revenue. And get this, saw foot traffic jump by about 40%.
40%, that's huge.
It really highlights how smart investments in existing assets can yield substantial returns. What exactly did they do in the Oasis Wing? Was it just a cosmetic facelift or more structural? Tenant mix changes. How do you get a 40% foot traffic bump?
It's definitely more than just a facelift, it's a combination. The Oasis Wing AEI focused on optimizing the retail layout, bringing in new, exciting F&B options, enhancing the whole ambiance,
Yeah.
creating a more compelling visitor experience. It's not just aesthetics, it's about curating a vibrant environment that makes people want to stay longer, spend more. That, in turn, attracts better tenants, allows for higher rents. That 40% increase is a direct result of that holistic approach.
Makes sense. And they're doing more elsewhere.
Yes, Sunway Carnival Mall is refurbishing its existing wing Phase 2. Phase completion expected through May 2025. And the strong performance of its new wing, finished back in June 2022, really bodes well for a future NPI uplift once Phase 2 is done. They'd already secured over 90% tenant commitment for that existing wing back in March, which shows strong pre-leasing confidence.
And this all fits nicely with the broader retail market rebound in Malaysia, right?
Perfectly. Consumer spending is expected to increase growing economy, low unemployment, rising tourist numbers. Plus, you've got factors like the EPF Account 3 allowing more flexible withdrawals and a strengthening ringgit. All potentially positive for consumer spending, creating a favorable backdrop for Sunway REIT's retail assets.
But as they keep growing this retail segment, does that create any new concentration risks? Even with their overall diversification, is retail becoming too dominant?
It's a valid point to consider. While retail is clearly the powerhouse, management consistently emphasizes strategic diversification. Yes, retail is a significant chunk of their NPI, but their continued investment in industrial assets, their stated focus on logistics acquisitions, helps balance it. The risk is probably mitigated somewhat by the sheer quality and dominance of their main retail assets, prime, high-performing malls. And the Malaysian retail market, especially for well-run malls, tends to be quite resilient.
Still, something to monitor.
Definitely. Ensuring new acquisitions enhance diversification, not just pile into the already dominant segment.
Okay, let's move to the hotel segment. Navigating tourism recovery, but also some seasonal shifts here. Q1 2025 saw lower revenue, RM 16.1 million, down 16% year-on-year. NPI at RM 15.0 million, down 17% year-why. That sounds like a bit of a dip, especially with all the talk of tourism recovery. What happened?
Yeah, that decrease was mainly put down to the Ramadan season falling in Q1 2025 this year. Typically, during Ramadan, you see softer hotel occupancy rates and a dip in ICC activities, meetings, incentives, conferences, exhibitions. Travel patterns shift, both locally and internationally.
So a seasonal effect rather than a fundamental problem.
That's the explanation given, yes. More seasonal than fundamental weakness.
Because despite that Q1 dip, the bigger trend for hotels is positive, right? Benefiting from the tourism rebound across Southeast Asia. Malaysia's popular.
Precisely. Tourism Malaysia reported a 16% YoY increase in tourist arrivals for the first 2 months of 2025. And remember, Q1 2024 saw a huge 32.5% jump. Plus, the visa-free entry for key markets like China and India has been a significant catalyst. So while Q1 had that seasonal blip, the underlying fundamentals for the hotel segment seem strong due to tourism returning.
So long-term outlook still positive despite seasonal bump. Any other challenges mentioned? Rising costs for hotels come up, staffing, utilities, things that could squeeze margins.
The Q1 commentary did note an increase in competition from new hotels entering the market, especially in cities. That naturally puts some pressure on room rates. While it didn't explicitly detail rising operational costs for hotels this quarter, it's a known industry challenge. So, management's response. Plans for more proactive pricing, targeted marketing, and a bigger push on Amisi events in upcoming quarter.
Trying to fill those rooms and event spaces.
Exactly. And Malaysia's strength in Muslim-friendly and medical tourism is also expected to benefit Sunway's hotels, especially those near Sunway Medical Center. These niche segments often bring more stable demand.
Okay, let's turn to the office segment. A tricky area globally with hybrid work. How's Sunway REIT's portfolio holding up?
Well, in Q1 2025, the office segment saw revenue at RM 20.4 million, down 4% year-on-year. NPI was RM 12.4 million, and 11% DIC UI.
Why the dip?
Primarily due to two specific tenants in Sunway Putra Tower relocating to their own buildings back in 2024, plus higher assessment rates hitting in Q1 2025.
So specific tenant moves and higher fixed costs, rather than, say, a widespread drop in demand across the board.
It seems so, based on the commentary, but the broader market conditions are challenging for offices in Klang Valley. You've got that shift to hybrid work, plus a lot of new supply coming online, roughly 2.5 million squared expected in 2025, another 2.3 million in 2026. That creates an overhang, puts pressure on rents and occupancy everywhere.
So how does Sunway navigate that?
They're focusing on those AEIs again, upgrading air conditioning, lifts, transformers to make their buildings more competitive, Crucially, they're also aiming to meet green building requirements and achieve Malaysia Digital or MD status for the office portfolio.
Ah, the MD status. That helps attract certain types of tenants.
Definitely. Tech and digital companies often specifically look for MD-certified spaces. It signals modern infrastructure, connectivity, suitability for digital businesses. It's a key differentiator in a tough market.
Next up, the services segment. This one's seen some big changes recently with disposals. What's the latest?
For Q1 2025, revenue and NPI for services stood at RM 9.8 million. That was actually a modest 2% increase year on year. But that increase was primarily just the annual rental reversion, basically a pre-agreed rent increase for the Sunway University and college campus. That's the only asset currently contributing income in this segment.
Right, because the segment's performance reflects that major portfolio shift, doesn't it? It used to include the medical center.
Absolutely. The key factor here is the disposal of Sunway Medical Center, Tower A and B, back in August 2023. That was a major asset, and its rental contributions stopped then. So comparing previous periods isn't really apples to apples. The segment's current, fairly modest performance is really just driven by that single university campus asset.
And now there's another big change coming for this segment. The proposed disposal of the university campus itself.
Yes, exactly. A conditional sale and purchase agreement was signed on May 2nd, 2025. Proposed sale price, RM 613 million cash.
Wow, big number.
Huge. The deal's expected to close by the second half of 2025. It will further reshape the services segment, basically shrinking it significantly for now.
What's the strategic thinking behind selling what seems like a stable, income-generating asset?
It seems multifaceted. Firstly, RAM Ratings noted this disposal will significantly aid in de-gearing, meaning it'll help reduce their overall debt levels, providing more financial flexibility.
Okay, reducing debt. Makes sense.
Secondly, it's that asset recycling theme again, freeing up a substantial amount of capital from a mature asset, which they can then redeploy into potentially higher growth opportunities. Think industrial logistics areas aligned with their Transcend 2027 strategy. It's about optimizing the portfolio mix, potentially boosting overall yield long term.
Okay, makes sense strategically.
Yeah.
Finally, let's talk industrial and others. This segment seems to be booming, and it's a relatively newer focus for them, isn't it?
It really is booming, and it perfectly captures that opportunistic acquisition part of their strategy. Q1 2025 revenue surged 83% year-on-year to RM 4.2 million. NPI up 61% YoY to RM 3.2 million.
Huge growth percentages. What's driving that?
It's largely down to acquisitions, specifically Sunway REIT Industrial Prey, bought in Q4 2024, and crucially, improved occupancy rates, like Sunway REIT Industrial Pedaling Jaya 1. That property had an average occupancy of just 31% in Q2 2024 after being totally vacant before December 2023. So getting tenants in there made a big difference.
That's a massive turnaround for peddling Jaya 1. Vacant to 71% occupancy pretty quickly. What sparked that? What kind of tenants are they getting? And it sounds like this sector is riding some strong market trends.
Yeah, the PJ1 turnaround is a great example of active management meeting market demand. They upgraded the property to meet modern industrial specs. That made it attractive to logistics and e-commerce players who need efficient, high-spec warehousing. And yes, the sector is benefiting immensely from booming e-commerce. Huge demand for modern logistics, warehousing, especially for last-mile delivery hubs, regional distribution centers.
Government policy helping too.
Definitely. Malaysia's new Industrial Master Plan 2030, NIMP 2030, and the National Energy Transition Roadmap, NATR, they both emphasize sustainability and tech. That boosts demand for modern, green industrial premises in core locations like Shah Alam, Penang. These aren't just buzzwords, they directly shape what tenants need and what facilities command premium rents.
Any global factors playing a role here, benefiting Malaysian industrial?
Absolutely. There's a noticeable uptick in foreign interest because of global supply chain realignments. With ongoing trade tensions like those U.S. reciprocal tariffs we mentioned, manufacturers are looking to diversify production away from traditional hubs. Malaysia, with its location, skilled workforce, supportive policies, it's looking attractive. This creates opportunities for local manufacturers, logistics players, and, by extension, for quality industrial REITs like Sunway. It positions their assets well for both domestic and foreign tenants.
So pulling this all together, what does it mean for their strategic direction? Are they setting themselves up for sustainable growth? How are they managing the risks that come with being so active?
Yeah, it raises important questions about their forward strategy, especially around capital management, ensuring resilience against, broader economic shifts. Their past actions give us a good clue about their intentions balancing that aggressive growth with careful financial stewardship.
Let's quickly recap their acquisition strategy. 2024 was massive. 9 new properties, those hypermarkets and malls, pushing them over the RM10 billion AUM mark.
And they haven't stopped. That proposed acquisition of Aeon Malseri Manjung in Perak for RM 138 million, the conditional SPA was signed back in January 25, but it's still pending. They've actually extended the conditional period to August 2025.
Interesting. Shows they're still focused on retail expansion, but maybe being careful with due diligence, taking their time.
Seems like it, making sure the terms are right. And looking ahead, management says they're actively seeking opportunistic acquisitions, especially in retail, logistics, and services. It all aligns with that Transcend 2027 strategy. It's not just about bulking up AUM, it's about optimizing the portfolio mix, enhancing overall yield through strategic asset recycling.
So looking for assets with higher cap rates or potential for value add through AEIs or ones that solidify their position in growth sectors like e-commerce logistics.
Exactly. It's a deliberate shift towards a more dynamic, yield-focused portfolio, it seems.
Now let's talk capital and risk management. Crucial for any REIT, especially one growing this actively. How do their debt metrics look?
Okay, their gearing ratio as of Q4 2024 was 42%, comfortably below the 50% regulatory limit. That gives them flexibility. RAM Ratings also looked at their debt to OPBDI ratio, that's operating profit before depreciation, interest, and tax. It was 8.14 times at the end of March 2025. Their annual debt rollover rate was 62.19%.
What did RAM make of that?
They noted it as a relatively high leverage position. However, they expect these metrics to gradually improve over the next 2 years, driven by solid earnings growth and, importantly, that de-gearing effect from selling the university campus.
Relatively high leverage that can sometimes worry investors, even with a good outlook. What if things don't improve as quickly as expected? What safety nets do they have? Are there specific loan covenants they need to watch?
That's the critical what if. While RAM seems confident about the de-gearing, their report also highlights Sunway's strong access to capital markets and diverse funding. That's a safety net. If de-gearing is slower, they could potentially say defer non-essential AEIs, slow down acquisitions, or maybe even look for other asset sales that are more accretive. Typically, loan covenants are tied to things like gearing ratios, debt service cover. Staying well below that 50% gearing limit gives them a big buffer against breaching those.
Right. And RAM liked their fixed charge cover.
Yes, 3.0 times in Q1 2025. RAM called it adequate, if not improve. So having 3 times the operating income needed to cover interest payments, that's healthy.
Why is that specific ratio, fixed charge cover, so crucial for REITs, especially now with interest rates potentially moving around?
It's absolutely vital for REITs because they are, by nature, highly leveraged income vehicles. Their main job is distributing income. A strong cover like 3.0 times means they have a significant buffer. They can absorb interest rate hikes or temporary dips in income without, hopefully, jeopardizing debt service or distributions. Cash flow predictability and debt service capacity are paramount for REITs. It's a sign of good financial discipline.
And they are actively using debt for growth. Borrowings up RM 716 million year-on-year in Q1 25 to fund acquisitions and AEIs.
They are, but they're also managing the risk.
How so? On interest rates?
Yeah. As of March 2025, the split between fixed and floating rate borrowings was 48.52. That's a big shift towards fixed rates compared to Q1 2024 when it was 32.68.
Locking in costs. Smart move in this environment.
Very prudent. Provides more certainty. While their average cost of debt did edge up slightly, 3.92% in Q1 25 from 3.85% in Q1 24, it's a modest rise given the market. And importantly, they fully hedged their US dollar loans using cross-currency swaps. Takes foreign exchange risk off the table for that debt.
And overall financial flexibility. Can they access the capital they need for these ambitious plans?
RAM Ratings think so. They affirmed Sunway REIT's strong ability to access capital markets, noted their diverse funding profile, strong bank relationships. All that helps moderate the leverage and provides substantial flexibility. It suggests the financial community still backs them to fund future growth.
Okay, beyond the numbers, management team quality, ESG commitment, these are increasingly big factors for investors. What's the take on Sunway REIT's leadership?
They're highlighted for having extensive experience, a proven track record, especially good at navigating tricky markets, executing those strategic acquisitions, and delivering consistent returns. That long experience breeds confidence. You see it in their ability to pivot, right? Capitalizing on industrial growth while managing office headwinds. That shows strategic agility.
And transparency. Do they walk the talk in their reports and communications?
Their commitment to transparency and open communication seems pretty strong. Regular investor engagement, detailed reports, holding briefings, it builds crucial trust, allows for a better understanding of their strategy and performance.
And ESG, environmental, social, governance, becoming non-negotiable for many.
They're actively integrating it, implementing smart building solutions for energy efficiency, pursuing green certifications for offices.
Like what specifically?
Things like installing high-efficiency chiller plants, LED lighting. That reduces their carbon footprint and saves money on utilities. They're also chasing Green Building Index GBI certifications for properties like Sunway Tower, Sunway Putra Tower.
And that helps track tenants.
It does. Enhances appeal to environmentally conscious tenants, often contributes to higher occupancy, maybe better valuations. It's becoming vital as investors prioritize companies demonstrating both financial and sustainable practices. Good for the planet, often good for the bottom line too.
Okay, let's zoom out. The bigger picture. How does Sunway REIT's performance fit into and maybe even influence the broader Malaysian economy? They don't operate in a vacuum, right?
Precisely. A REIT like Sunway is deeply intertwined with the economy. Understanding those links helps gauge their resilience, their future potential.
Yeah.
Their performance often mirrors broader trends. They directly benefit from healthy consumer spending, strong industrial activity.
So what's the Malaysian economic context they're operating in, the outlook?
Well, the forecast for Malaysia's economy is pretty healthy expansion between 4.5% and 5.5% growth expected in 2025. That positive trajectory, plus rising consumer confidence, low unemployment, more tourists arriving, it all points towards positive consumer spending, which naturally bodes well for Sunway's retail and hotel segments.
But there are always potential headwinds, aren't there? What are the main economic concerns that could trip them up?
True. Ongoing worries include the planned expansion of the sales and service tax, SST scope, and also fuel subsidy rationalization in 2025. These could lead to higher operating costs for businesses, including REITs themselves, and potentially dampen consumer spending if inflation picks up. That domino effect could hit foot traffic, retail spending, or increase costs for their tenants, eventually feeding through to rental income. Management will be watching that closely.
And global factors, like those U.S. reciprocal tariffs on Malaysia, how might something like that indirectly hit a property company like Sunway?
Yeah, that carries risks. Heightened inflation, maybe eroding business confidence, potentially impacting overall GDP growth. For Sunway, tariffs could indirectly affect demand for their industrial spaces if Malaysian manufacturers face higher export costs, maybe slowing expansion plans. Or it could hit consumer spending if it means higher prices for imported goods sold in their malls, squeezing retailers. Management stated they're monitoring it closely. These external pressures can definitely have an indirect effect.
So, looking long-term, what's your take? Sunway REIT's growth potential versus the key challenges ahead.
Overall, I'm optimistic about their position. Sunway REIT seems well-placed for continued growth. They've got the solid track record, that diversified portfolio, strong management, and they're actively chasing opportunities in high-growth sectors like industrial and logistics. They really are, as we said, playing chess, thinking several steps ahead, not just reacting, actively shaping their portfolio.
And it's not just about buying any assets, but the right ones. Those modern, high-tech facilities attracting premium tenants.
Exactly. Their strategy seems to emphasize quality over mere quantity, acquiring modern, high-tech facilities that attract those premium tenants. That should lead to more sustainable, higher-yield returns, as those properties usually command better rents, have higher occupancy, building a future-proof portfolio.
What are the key challenges they'll face on this path, especially with retail and logistics evolving so fast?
I think the key challenge is managing that growth effectively while keeping standards, high asset management, tenant relations. They need to constantly adapt, changing consumer habits and retail e-commerce, omni-channel experiences, and anticipate the impact of emerging tech autonomous vehicles, drones on logistics and retail space demand.
Like needing smaller last-mile delivery hubs or how warehouse automation changes space needs.
Precisely. These aren't just sci-fi ideas. They're trends that could reshape real estate needs sooner than we think.
So their proactive stance is crucial for staying ahead, turning potential disruptions into opportunities.
It absolutely is. That proactive approach, shaping their future, not just reacting, is critical for staying ahead in a competitive landscape. That foresight, that willingness to divest and acquire strategically, those are major assets in themselves.
Right. We've really gone deep on this one, explored pretty much every facet of Sunway REIT's latest performance, their strategic moves, the economic backdrop. So for you, our curious listener, What's the big takeaway from all of this deep dive?
I think the big takeaway is that Sunway REIT presents a compelling profile. Consistent performance, a forward-thinking strategy, especially if you're interested in the Malaysian real estate market. They've shown strong operational efficiency, strategic buying in growth areas, and a clear commitment to balancing ambitious growth with careful capital management. They're actively recycling assets to optimize the portfolio, enhance yield, positioning themselves for long-term resilience in, let's face it, a dynamic economic environment.
But as always,
But as always, like any investment, it absolutely warrants your own thorough homework. The information we've unpacked today hopefully provides a really strong starting point for that research.
indeed. And here's a final provocative thought for you to mull over. As Sunway REIT keeps strategically rebalancing its portfolio, buying significantly in growth areas, selling mature assets like the university campus race, how might these continuous shifts impact its core identity, its long-term risk profile? Does the very diversification that's been its strength start to evolve into something new as they actively sculpt their asset base? It's not just about the numbers changing, but maybe the evolution of the entity itself. What does that mean?
That's a fascinating question. Definitely one worth pondering as you maybe look into the source materials yourself for even deeper insights. We'd strongly encourage you to keep monitoring market trends, keep an eye on Sunway REIT's future reports, see how these strategies actually play out over time.
Absolutely. The more you know, the better equipped you are. Thank you so much for joining us on this deep dive. We'll be back soon with another exploration into a different corner of the financial world. Until then, happy researching.